Hello and welcome to the CNBC TV18's Mumbai Newsroom. I'm Sonal Bhutra and you're watching Your Stocks. This is a show where we take up all your queries and get them answered from our experts. And joining us today is Rajat Bose of RajatKBose.com, an independent market expert, Shahina Mukadam, to answer all your stock queries. Mr. Bose, Shahina, thanks a lot for joining us and taking us through what you would think of the queries coming in from our viewers as well. And with that, we'll do one thing. We'll straight grow to our first query today. It is Jay Krishnan, who's writing to us from Vatakra, Kerala. He holds 5 shares of Bajaj Finance at 7,200 rupees per share and 20 shares of Jubilant Foodworks at 600 rupees per share. He wants to know future prospects of his investment. Rajat, what do you make of these two stocks, high pedigree stocks? And we've been talking about higher valuations for these, but what should our viewer do with this?
Well, to talk about Jubilant Food, I would say that Jubilant Food actually tried to spearhead some kind of a recovery middle of this year, around June or so, from the levels of about 440 or from there had been a 200-point run, and after that it has started moving down again, and chances are that it is likely to go further down and it might hit 500 levels, where your 200-week moving average, mind you, I'm referring to 200-week moving average, which previously supported during its sharp downfall. Unless the investor is actually looking at the long term. When I say long term, I define it as a minimum of 3 years, if not more. I mean 5 years or so. Staying in this stock for a shorter period may not yield much. So this is it. If you are a long-term investor and if you are willing to hold on to it, you have to be ready for a long period of 3 years. And if you want a stop loss, I would say your stop loss should be anywhere between 480 and 500. If it were to go there and sustain there on a weekly basis, then you would do better to get out of it. And regarding Bajaj Finance, what I would say is that I like Bajaj Finance a lot. In fact, it's one of the best finance companies. It has shown a major recovery from around, say, 5,000 levels to 7,500, 600 levels. But at the moment, it is showing distribution. In fact, barring aside few index stocks, most of the stocks, if you look at, they are showing distributions, and chances are that there is a correction which is knocking at the door. Bajaj Finance is likely to go down because its short-term moving averages as well as 200-day moving average all are now above the current price. That signals a weakness, and this weakness might take Bajaj Finance down to something like 6,000 to about 6,200. That may not happen very easily. I mean, it's not going to be a sharp fall and it will hit 6,000. No, it will gradually go down to those levels. But if an investor is willing to stay put in Bajaj Finance for a longer period of time, say 3 years or 5 years, even I would say that I personally would not hold Jubilant Food in that high a category, but Bajaj Finance is a great stock, a great company, a great franchise, and it has got great data analytics, which is its real competitive advantage, and it will do well over the long term, but in the short term it is likely to go down.
So that's the technical update on these two stocks. In the long term, you expect it to do well. In the short term, Bajaj Finance could go down. Shahina, what are the fundamentals suggesting for these two stocks? Of course, we know that they are blue chip stocks, so to say. But in terms of valuations and in terms of future growth prospects, what do you have to say?
I will concur with Rajat. Quality stocks. But in the shorter to medium term, I think both the stocks will go on a consolidation phase. Bajaj Finance, if we see FY23, their names are expected to remain stable, but with borrowing costs going up, and a large part of their loan book is in fixed loan book, I think there would be some pressure in margins over the next year. Competition is also hotting up, so I think it will be in a consolidation phase. Quality stock, no doubt, but I would also if you want, you can book profits at current levels and then look to re-enter at dips or over a slightly longer term period, you can re-enter after 6 months or a year by re-looking at the stock. Similarly is with Jubilant. There, I also believe it's a quality stock. QSR is, the whole sector is doing well. Raw material prices also sort of softening and demand picking up. At the same time, I think valuations are very expensive, which is why the stock is likely, in my view, to remain in a consolidation phase over the next couple of months, maybe a year or so. So the investor would be he would be in a better position if he switches from these stocks to some other stocks which sectors which are really looking good at the current level, or then holding on and then averaging over the next couple of quarters and then holding for the very long term.
Okay, so that is about Jubilant FoodWorks and Bajaj Finance. Let's go across to our next query. Nandan is writing to us from Bangalore. He holds 240 shares of IEX at 100 rupees a share and 267 shares of Tata Power at the same rate, 100 rupees a share. He's a long-term investor and wants to know whether to hold or sell at current levels. Shahina, let me come to you for this, because IEX has been a darling of the market for a long time. Saw substantial gains last year. A lot of it has come down. Tata Power too, after this stake sale in their renewable power business, it has not seen much gain, so to say. What is the fundamental approach for these two stocks?
Well, these stocks, for the very long term, I think one can continue holding. IEX, of course, is a concept stock there. As you know, power trading currently in India is a very small percentage of the overall, the power distribution in India. And I think to that extent, the market potential for growth is huge. IEX as a stock, the price, actually, the post-bonus last year, the correction that has taken place is never really recovered from there. But for a long-term investor, I think one can continue holding IEX. It's in a very strong position in terms of market share also. Tata Power, similar story. I think the work that they are doing in renewables is actually going to really pay dividends in the very long term. There is, of course, as you know, talk of value accretion by, sort of demerging various sectors, getting in new investors. So I think Tata Power is also well placed at current levels, having corrected. So I would continue holding both the stocks for the long term.
Okay, so continue to hold it for the long term. Rajat, I will come to you for the next question, and it's an interesting one. Mr. Selvaraju R is writing to us from Goa. He holds 100 shares of Paytm at 980 rupees per share. So definitely big losses that he's sitting on. He wants to know whether it's time to book his losses or he should stay invested. He also wants to know whether it would be wise to invest in M&M at current levels. Rajat, can you hear me? Okay, Shahina, then let me take it to you, because we've been talking about Paytm's mounting losses. We've been talking about how it has eroded investor wealth, down almost 70% from the listing price. What are you suggesting here? Is there's any scope for a bounce back, and should the investor invest in M&M?
I would suggest that even at current levels, investors making loss in Paytm, he should still exit, because there are a lot of investors, long-term investors that are lined up to actually continue to sell their stake. And in terms of business, I think the whole business has sort of changed with the new payment systems that are coming in for Paytm, making Paytm not look that exciting for the very long term. I would actually exit. And M&M, I don't think one should buy it at current levels. If one wants to look to buy, I think one should look at it only at dips from here.
Okay, so don't buy M&M and should book losses in Paytm. Already has seen a sharp fall from the highs. To the next query now, Praveen Kumar Gandhi calls us from Bangalore with a query. He has investments in Happiest Minds and Samvardhan Motherson International. Go ahead, sir.
Yeah, okay.
Hi, sir. Good afternoon. Can you hear me?
Yeah, good afternoon. I can hear you.
Yes.
Tell me, okay?
Yes.
Yeah,
What's your query?
Happiest Minds, which have sort of averaged at 1,040, and Samvardhana International, Motherson at 83.
Okay, so you want to know whether you should continue to stay invested in these two stocks?
Yeah, whether I should continue to hold them or exit, or I don't mind waiting for a couple of years.
Okay, so you don't mind waiting for a couple of years. So it looks like a long-term investment for you. Rajat, it looks like a long-term investment. Tell us what are the charts suggesting then, Shahina? Let me come across to you.
Shall I take the question? Happiest Minds, I would suggest that the investor continues to hold. There, I believe, it is it's a very nice mid-cap IT stock, which has most of its turnover in digital, which actually is doing pretty well. You saw last quarter, they have grown 5% QOQ basis. I think in dollar terms. So it looks like a very interesting bet to hold for the longer term. And as far as Motherson Sumi goes, I think I would suggest that the investor exits from Motherson and maybe gets into an actual OEM rather than being. Motherson is actually a supplier to OEMs, and if you see the return ratios, they're very low. ROC, return on net worth, profitability seems to be impacted. I think, of course, things will look better with raw material prices coming off, but why not buy a direct play of OEMs? Something like a defense stock. Defense stocks are doing well, and I think they will continue to do so. Something like a HAL, you have BL that is doing well, or even in the CV space, Ashok Leyland. So my picks would be in that segment.
Okay, so point taken. That's the fundamental view. Rajat, we lost you for a bit, but now you're back. Tell us, what are the technicals and the charts for these two stocks looking like?
See, one Motherson Sumi.
Motherson, Samvardhan Motherson International. Yes, the demerged entity. And there's also Happiest Minds that the investor wants to know about.
Okay, what I do is I start with Happiest Minds. Happiest Minds actually is, it's in a consolidation mode, and this consolidation may continue for a bit longer till such time it clears the range between 1100 and 1200, being a software stock that once it takes out those levels, there would be good movement, but it is not anymore that stock which actually shoots up very fast and goes up right away. That kind of a situation is not being seen in technicals. It is still under the 200-day moving average. In fact, most of the moving averages, even 20-day moving average, is higher than the current price. That's why I'm saying that it is consolidating, and in this consolidation it may move between say 950 and about say 900 or 875, but the kind of larger pattern that I see, it can actually scale up and cross that Rubicon of 1150. Once that is taken out, it will move. So if he is a long-term investor, he can continue with it. Regarding Samvardhana Motherson, I think you are talking about a stock which is currently ruling at 57.50, right? Because my trading view screen is showing that.
It's the 71. It's the 71 rupee stock that I'm talking about, Rajat. I think that one is Motherson Wiring.
I couldn't find out.
No worries, no worries. We'll do one thing, Rajat. We'll come back to you. For now, we'll slip into a short break. Before we do that, a quick programming note. To fully commit to the cause of bridging the gender parity gap at the workforce, CNBC-TV18 is all set to lead charge with a one-of-a-kind mega initiative, Future Female Forward, the Women's Collective, presented by HSBC. The initiative will be officially launched through an exclusive on-ground event on Friday, November 25th, in the presence of Shireen Bhan, Managing Editor, CNBC-TV18, Mr. Hitendra Dave of HSBC, and other women leaders of India Inc. Also in attendance will be some of the most influential voices from the business, entrepreneurship, and entertainment spaces. Don't forget to tune into CNBC-TV18 on Friday, November 25th, 5:30 p.m. onwards. Welcome back. You're tuned into Your Stocks, and we still have with us Rajat Bose of RajatKBose.com and independent market expert Shahina Mukadam to answer all your stock queries. And to the next query now, Sri Krishna Kittu is writing to us from Hyderabad. He holds 135 shares of IOC at 68 rupees and 30 shares of Wipro at 392 rupees a share. He's a long-term investor and wants to know if he can hold the stocks for 5 years. Shaina, before I come to you, Rajat, let me come across to you, and I wanted to understand what the outlook for these IT stocks in general is. Also for the oil marketing companies, they have seen a sharp fall. Mounting losses in both their segments is something that has hurt these stocks, but valuation wise still very okay. What are the charts suggesting for these two stocks?
I would say that if you look at say IOC, I mean, it's a great dividend play. A lot of people buy it for dividends, and a lot of people also tend to think that this is one stock that is highly undervalued. I mean, most of these oil refining companies are undervalued. Personally, I would suggest your viewers one thing. Look at the return ratios. A little earlier, Shahina also referred to them. These companies are commodity companies, and the return ratios will always be not that great. Even if you consider it to be a great value going forward, you would be better off looking at companies actually that is posting a return ratio, especially I'm very keen on looking at ROCE. If the return on capital is above 25%, that kind of companies, even if they post, say, a couple of quarters bad results, like say DV's Lab kind of stocks, actually they might have posted bad results, but they would do very well going forward. They take these kind of things in their stride, and the expectations treadmill that the stock market produces, because there had been 12 quarters of good performance, so people expect this to continue. It will, but there will be blips of this kind, that 2 quarters may not be that great. But when you look at a stock like IOC or BPCL, either there will be divestment of this or that, and ultimately you will be disappointed. There will be enormous delay. See, why get into this? You have so many stocks, especially good businesses, that you can buy into, and be patient when they fall. Like say I told about Bajaj Finance. You get Bajaj Finance at a lower price and get into that. It will continue to make good amount of money, and its return ratios will also be pretty good. But these kind of stocks, you will continue to think that they are value. You may buy, may get some money, but not much. That's the point.
Okay, point taken. Shahina, what are your thoughts on this one?
Yeah, I would concur. I think, it is better to switch from both these stocks. Better quality stocks I could suggest that have potential. For example, if you look at IT, you have TCS, it's the largest, most expensive in the sector, but likely to give you a very decent return if you're holding it over a long-term period. So I would prefer it over Wipro. And for another stock, for example, IOC, despite the government giving it certain set-offs for losses that it made in LPG. I think, it's likely to continue to remain range bound at best. If an investor wants to exit, you can look at a slight bounce and exit, but at the same time, I would exit from the stock over a period of time and switch into a better quality stock like maybe an ITC and hold those stocks for the long term. Because clearly this investor, long-term investor, he should get into stocks which are likely to give you a good return, consistent return over longer term.
All right, point taken there. Moving on to our next query now, Gagan Gowda, who's writing to us from Bihar. He wants to know about the prospects of Hindustan Unilever as the stock is falling. Also, he wants to know whether it would be wise to add Westlife to the portfolio in the current situation as restaurant menu prices are soaring. Of course, that is something that we have all faced, but that does not stop anyone to go to these restaurants, considering the SSSG of Westlife this time has been stellar. Shahina, let me come to you. What do you suggest? HUL has been falling, but do you think this is the year for consumption stocks, or say calendar year 23 is?
Well, let's hope. I think, Karen, if you see HUL's portfolio, they have actually moved into, they're increasing their premium segments, the contribution from there. The new products that they have launched over the last couple of years is now contributing a bigger chunk of their revenues. Nutritional, which they acquired in the last 2 years, is actually likely to start contributing. With raw material prices still which are high, if they correct, I think there the margins could improve. I would continue to hold on to HUL. And as far as adding, I think Westside, if you want to add something in QSR, Westside is the best bet in QSR segment. And one can look to add it at current levels. I would be pretty comfortable if you're looking at a medium to longer term.
Okay, point taken. Rajat, technical update on these two names?
See, if your investor is a long-term investor, then I would say that continue with HUL. Although there can be some short-term correction where it might test its 200-day moving average, which is just below the 2200 level. That can happen, but as a long-term investor, you take that in your stride and you continue with it, because the return ratios and from all angles, this is a great company and this will continue to perform. You don't have to bother much. But regarding Westlife, I would say you can continue to hold, but don't buy at current prices, because it shows that there is a possibility that Westlife might actually correct, and in that correction it may actually shade points to that say about 10% to about 15%, because I'm expecting an intermediate term correction in the market, and there Westlife may actually seek lower levels, consolidate, and then move up. But both the companies are great if you are a long-term investor. There is no problem as such.
Okay, so positive outlook as far as the long-term prospects of these two stocks are concerned. Shahina and Rajat, thanks a lot for joining us today and taking us through all those queries and answering them so patiently as well. Well, that's all about viewer queries today. For the markets, Nifty is steady at that 18,285 mark. We have the last 1 hour of trade, which is very crucial considering that we have the monthly expiry tomorrow. Bank Nifty continues to outperform the benchmark, so that one is about up around 0.7%. But of course, we'll get you more updates on the other side of the short break. For now, that's all we have on the show. But do remember to email us your queries and we'll address them with our experts. Stay tuned for Closing Bell to take you through the last hour of trading session.